Welcome to the Retirement Guide Podcast. I'm your host, George Jameson, owner of Capital Wealth Group, a flat fee only advisory firm. Whether you're nearing retirement or already retired, join me each week as we explore the world of retirement planning and equip you with the knowledge and tools you need for a successful retirement. So let's get started. Today we're talking about asset allocation. And simply put, asset allocation is the mix of investments across different asset classes, such as stocks, bonds, and cash. In this episode, we'll dive into asset allocation, its importance in shaping your financial journey, and how to determine if you have the right mix for your unique goals. So first, understanding asset allocation. The goal is to create a diversified mix that aligns with your financial goals, risk tolerance, and investment time horizon. By spreading investments across various assets, you aim to optimize returns while managing risk. In asset allocation planning, the decision on the amount of stocks versus bonds in your portfolio is a very important decision. Just simply buying stocks without regard of a possible bear market can result in panic selling later. One's true risk tolerance can be really hard to gauge until you have experienced a real bear market with actual money invested. Finding the proper balance is key. Traditional assets are equities, bonds, and cash equivalents. And then you have alternative assets that may be considered, like commodities, REITs or real estate, annuities, private equity, hedge funds, and so on. However, today, I will stick with traditional assets like stocks, bonds, and cash for this discussion. So finding your ideal mix, determining the right asset allocation for you involves a thoughtful assessment of your financial profile, risk tolerance, time horizon, and financial objectives. If you are nearing retirement or already retired, this is often when many of you make changes to your overall investment portfolio. The general trend is to reduce some of your stock allocation and increase your bond and cash allocation, but that's not always the case. I get this question all the time from those nearing retirement. Should I be moving stocks to bonds? While it's not a satisfying answer, the real answer is that it depends. The decision of whether to shift your investments to a more conservative asset allocation will depend primarily on your longer-term goals, personal drivers of your risk and return profile, your income sources in retirement, expenses in retirement, and your personal risk capacity. Before making any asset allocation decisions, I suggest you start by reflecting on your long-term goals for these savings. What do you intend to use the money for? When do you need the money? How much do you need? Gaining a clear understanding of your longer-term goals will largely inform your time horizon, risk tolerance, and return objectives, the three inputs which collectively drive asset allocation decisions. If you find yourself falling short in saving enough for the retirement lifestyle you desire, you may need to either cut back on expenses or get a higher return on your investments to meet your retirement goals. However, seeking higher returns often involves taking on more risk. To achieve this, you might consider prioritizing capital appreciation by having more exposure to stocks. However, be aware that this approach comes with an increased risk of uncertainty. It may or may not be a wise decision, especially in the initial years of retirement, when you may need to start withdrawing funds right away. On the other hand, if you're confident that your various retirement income sources can adequately support your spending needs, you may opt for a lower return goal that focuses on preserving capital rather than pursuing aggressive growth. In this scenario, shifting to a more conservative allocation in your retirement plan could be a prudent choice. And then alternatively, if you have accumulated more than enough savings for your retirement and aim to pass on assets to your future generations, consider a different strategy. Maintaining an aggressive, equity-oriented asset allocation could make sense, especially if you have a substantial risk capacity and can adhere to a long-term plan. However, it's crucial to ensure that you have both the risk capacity and risk tolerance to stick with such a plan. It is also helpful to reflect on your own behavioral approach to investing. This is commonly referred to as your willingness to accept risk. Are you able to stomach equity market drawdowns of only 5%? Or can you stomach 10%, 20% or more drawdowns? In the bear market of 2000 to 2002 or 2008, did you sell on the way down during those challenging periods or hold on and even buy more? Together, your ability and willingness to accept risk form your risk tolerance. The biggest risk to success with a stock-heavy portfolio is selling when the market turns against you. Having the fortitude to stick with the positions during volatile periods in the markets indicates a greater willingness to accept risk. This can nudge your risk tolerance upward and justify holding a larger relative equity allocation. Of course, again, it is critical that you align this overall asset allocation with your long-term goals, time horizon, risk tolerance, risk capacity, and risk return objectives. So now let's look at various reasons why asset allocation often fails to work. So number one, human behavior is inherently biased. Even though we choose an asset allocation, implementation is a challenge. And number two, you agree to asset allocation, but after some good returns, you decide that you really wanted more risk. And then number three, you agree to asset allocation, but after some bad returns, you decide that you really wanted less risk. And then number four, your risk tolerance is not knowable ahead of time. And then number five, security selection within asset classes will not necessarily produce a risk profile equal to the asset class. And then finally, number six, the long-run behavior of asset classes does not guarantee their shorter-term behavior. So in conclusion, in the blueprint of financial success, imagine asset allocation as the builder, carefully choosing the materials to construct a sturdy and well-built house. Take a moment to understand your financial needs, periodically review your goals, and ensure that your mix of assets forms a resilient foundation for your home. With the right combination, you're not just investing, you're constructing a financial home that will last. And that wraps up today's episode. Hope everyone has a great day. Thank you for tuning in to this episode of The Retirement Guide. If you enjoyed this episode, please subscribe and leave a 5-star review to help others discover the show. For questions, ideas, or discuss your retirement plan, reach out to me, George Jameson, at Capital Wealth Group. Visit our website at capitalwealthplan.com to learn more. Thank you for listening. Stay tuned for more insightful retirement planning in future episodes. And now for the disclaimer. The information discussed in this podcast is for general explanations and education only. It is not tax, legal, or investment advice. Before considering acting on any information heard here, first consult with your tax, legal, or investment advisor. Thank you and have a great day.